Good afternoon. It's a pleasure to return to the Empire Club to discuss the outlook for gold and precious metals in 2011. I know this may appear to be somewhat of an enviable job, getting to speak about the one asset class that seems to continually outperform all others year after year. But it's a double-edged sword. I've struggled to find an appropriate simile. The best I can come up with is that speaking about gold is like one of those good news, bad news jokes. You know the ones. Your doctor phoned with some good news and some bad news. The good news is that they will be naming a new incurable disease after you. Well, in this case, the good news is that gold is rising. The bad news is, well, nearly everything else about the economy. This year we traveled to the Middle East, the Far East, and South and Central America to discuss gold. The different mindsets about gold that we encountered there surprised all of us. Most people in these countries see gold as a protector of wealth. In the West, we view gold as a commodity for speculation. Western economists treat the act of buying gold as an admission of defeat, and their attempts at disparaging gold's steady rise came even more tenuous than ever this past year. Some of these disparaging opinions include financial tightening will cause commodity prices to fall. Gold is in a bubble. The gold stocks haven't confirmed the gold bull. And perhaps most desperate of all, the economy is on the road to recovery. Despite these protests, gold has another remarkable year. It was up 25% in 2010. Which marked its 10th straight annual gain. Although we are speaking about gold today, I'd be remiss in ignoring silver's performance. Silver is up 78% in 2010, as it is, like gold, beginning to assume its role as a monetary metal. Platinum was also up 17%. When we look at the 10-year chart of the US and Canadian dollars, the euro, the British pound, and the yen, we see that these five major currencies have lost between 70 to 80% of their purchasing power against gold over this 10-year period. In truth, gold is not rising, but currencies are falling in value, and gold can therefore rise as far as currencies can fall. I'd like to pick up where we left off last year with a review of the three dominant medium-term trends that put upward pressure on the price of gold in 2010 and will likely continue in 2011. Then I'd like to look briefly at the three longer-term, irreversible trends that will put downward pressure on currencies, resulting in upward pressure on gold for decades. First, the three dominant mid-term trends we discussed last year are central bank buying, movement away from the US dollar, and China. In 2009, for the first time in 20 years, monetary gold or central bank and investment buying outpaced gold buying for industrial or jewelry purposes. In 2010, China, Iran, Russia, and India's central banks were all significant buyers as they moved cash reserves into gold. In the third quarter of 2010, the Russian central bank gold holdings rose 7% to 756 tons, and the central bank bought two-thirds of its own gold production. In December, we learned that China had imported 209 metric tons of gold in the first 10 months of the year. This was a 500% increase over the same period of 2009, and on top of their world-leading domestic gold production. By the third quarter, India's gold imports, both commercial and private, for the year were 624 tons, putting them 100 tons above the previous year's total of 595 tons. Fourth quarter purchases could put India's annual total over 750 tons. China and Russia need to acquire gold to bring their gold reserve ratio to outstanding currency closer to the Western central banks. Russia needs to acquire at least 1,000 tons, and China at least 3,000 tons to remain on parity with the U.S. Chinese officials have stated publicly that China would like to acquire at least 6,000 tons. Unofficially, they have stated targets as high as 10,000 tons. Last year, we quoted a November 2009 story written by veteran journalist Robert Fisk, claiming Russia and China, along with France, were working on an agreement to trade oil with Arab states using currencies other than the U.S. dollar. As expected, central bankers fervently denied these rumors. The U.S. dollar has since 1973 been the only currency that oil could be traded in. This is the only reason the U.S. has been able to amass nearly $14 trillion in debt. Loss of the petrodollar's hegemony would have a devastating effect on the U.S., as this is essentially the only reason foreign countries in the past needed to hold U.S. dollars. On November 24th, 2010, China and Russia officially quit the dollar and agreed to use each other's currencies for bilateral trade, including oil. Official trading on Moscow's MISEX index began December 15th, 2010. In 2009, Robert Zoellick made his well-publicized comment that the U.S. would be mistaken to take for granted the dollar's place as the world's predominant reserve currency, and that, looking forward, there will increasingly be other options to the dollar. In 2010, he continued hinting at a new reserve currency made up of 5 currencies with gold as the reference point. He also called for a new Bretton Woods agreement this year. Now, Mr. Zoellick is no lunatic goldbuck. He is the president of the World Bank. Last month, I was speaker and panelist at the China Gold and Precious Metals Summit in Shanghai. I can confirm that Chinese buying, both official and public, is a major trend that is not only well in place, but may be the single most important influence on the price of gold in 2011. As I said, the Chinese see gold quite differently from the way we see it. If we are to understand gold's price direction in 2011 and beyond, I believe it is essential to understand the mindset the Chinese have built around gold. Although the forming of economic mindsets is a complex topic, I'd like to simplify how major financial mindsets are created. What our government, our banks, and financial media tell us about money is what most of us will accept as our financial mindset or financial reality. If anyone doubts the power of the government economic policy to shape economic reality, just look at how we have changed our attitudes toward debt, saving, and economic value over the past 40 years. Our current debt-based mindset began to form the day the U.S. dollar, as the world's reserve currency, was removed from its final international peg with gold in 1971.